Hello everyone, my name is Ben Decker, and in this video I'm going to go over the 442 hedge, which is my first variation of the 441 that I previously went over. So for the 442 hedge, you're going to first set up the 441. So I'm going to go into the SPY. In the option chain, I'm going to go down to, typically I would go closer to 45 days to expiration. Here for the monthly expirations, I can either do the April 16th that has 35 days to expiration, or I can go out to May 21st, which is the 70-day to expiration. Just to give myself a little bit more time, I'm going to go out into the May expiration. So I'm going to click on that, and that opens up the option chain here. I have the bid, ask, and delta up at the top. So to start with the 441, I'm going to buy a $5 wide put debit spread, and I'm going to find the one that is going for a $1 debit. So the Tastyworks software here, I'm just going to move these strikes up until I find one that's close to $1. So here I'm going to do the 377, 372 put debit spread for $1.01. So I'm going to buy 4 of those. And now I'm going to find the put that is going for $4.04, and I'm going to sell that. So if I scroll up on the page, that is going to be the 352 short put. So here you can see it defaults to a quantity of 4, so I'm going to decrease that to 1. And here you'll see that this trade is going to be put on for a 5-cent credit. And if we go to the curve analysis here, just as a refresher, here's what that risk graph looks like. So here our break even is around 330, 332, and the risk is getting long 100 shares at that cost basis. So with the 441, you would leave this trade on basically until expiration, or you could take off this put once it's basically worthless. So the problem that I found with this trade is that on a sharp down move, this short put will increase a lot quicker than the spread does. So I wanted to figure out a way to take off the short put but keep my spreads on, and I didn't want to pay for the hedge. So I decided that I would sell 2 of these puts and take them off at 50%. And by doing so, once I take this off for 50% profit, both of them, my spread would be on for free. So if I sell 2, Tastyworks shows that I'm getting 207 credit, but this is not correct. Tastyworks sees this as a 122 twice. So if I click review and send, you can see my estimated trade cost here is 414 credit. So if I take off these short puts at 50%, that's $2 each that I would pay. So I would end up paying about $4, and that would cancel out the 414 credit. So that's how I'm getting that this hedge would be left for free. So here is what the curve looks like. So you can see my break even is a little bit higher for this one. It's around 340. And instead of 100 shares getting long, I would be getting long 200 shares at 340. So you can see here my buying power effect is almost $8,000. So it's quite a bit more than the 441, and you want to make sure that your account can handle 200 shares of SPY. To manage this, you could either let these expire if there's a big down move that goes below 340, or you could roll the short puts to the next month, or you could close the trade altogether before you get assigned. So here is what the trade looks like on entry, but you'll be able to see here if I take off the 2 short puts and I say this is, in the end it'll be something like a 5-cent credit. So what I did here was take off the short puts and left on the hedge and assume that I did this for a 1-cent credit. So here you can see my max profit is $2,000 and I've locked in that $4 profit all the way to the upside. So this is the hedge that I end up wanting to have for the long duration of the trade. So your risk is up front until you can get rid of the short puts, but once you buy that back at 50% profit, then you're left with a free put debit spread, 4 of them, to hedge your long positions. So that was the 442. In my next video, I'm going to go over the 444 variation, which is the variation that I use. If you like this video, click like and subscribe, and I will see you in the next video.